Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week, I would say equity markets recovered quite a bit and certainly ended last week with a bit of a bang on Friday on the back of the PCE inflation numbers. Expectations were fairly strong that inflation was going to come in a little cooler than expected, and largely we got numbers that were in line with expectations, and that kind of gave the markets a lot of um, reason to rally. Even though intraday there was quite volatile, the closing on Friday was extremely strong, a lot of volume on that close. Yesterday's volume also was decent. However, the one thing is that yesterday we didn't get any follow through. So the question really is this week. If we look at the S&P 500, we closed last week above this recent high above 5250. Yesterday we closed above 5250, but it really lacks momentum. And the question is whether or not markets can continue to push to new all-time highs, or this is likely going to fail and continue moving lower. So we'll take a look at the charts and try to answer that question going forward. When we look at the NASDAQ 100, very similar price action. We got above that 450 recent high from back here in March. We broke above that new high, failed below it intra-week, but we closed the week above that 450 level. Yesterday, we managed to get back above that level as well, but closed a little bit lower from the open. So not the follow through that you typically want to see after what was a big day on Friday, certainly into that close. So overall, the equity markets and the lack of participation yesterday is not particularly strong for equities to continue to print new all-time highs. We did see some improvements last week. We did see some improvements, especially into going into Friday. But we'll take a look at some other charts to help answer that question. Small caps did actually do fairly well, especially value-based small caps. We do see value-based small caps kind of show quite a bit of strength here last week, relative strength from the perspective of it didn't drop as much intra-week. Friday's close wasn't as strong. Yesterday's open was stronger, but closed kind of in the middle. So small caps yesterday not getting the follow through we saw from the other equity markets, or not getting the follow through that we'd like to see. So all of the equity markets we're seeing that we're tracking, small cap technologies, large cap, all lacking that follow through on yesterday's price action. And then the equal weight S&P 500 index, same thing. As you can see, still nowhere near that 170 all-time highs. So lack of participation on this market rally is not a particularly good thing. It doesn't instill a lot of confidence that markets will reach back to new all-time highs and continue moving higher. We do continue to see growth outperform value, even though it's quite choppy here. Last week, we saw value outperform growth quite a bit, especially towards the end of that week. We did see that reverse a little bit here yesterday, but overall, I would say what we're getting is a lot of chop, a lot of outperformance for a few days, underperformance for a few days, and then quickly reversing. So not a strong trend of growth outperforming value or vice versa. So those are some of the concerns that we have here with the equity markets that's not particularly strong. Now, the one big change that we have seen is commodities as an asset class have really shifted in terms of tone. We had this since the beginning of last year, or I'm sorry, the end of last year going into the middle of this year, very strong outperformance for commodities. And then we started to see that trend deteriorate a little bit over the past couple of weeks, past couple of months. And just yesterday, we saw this breakdown below this major support level at 2175. That was also contributed with a lot of heavy volume as well, as you can see from this candle. And that really gives us a much more bearish signal here for commodities. So for gold, for oil, energy stocks, these are all correlated with that. So this has some ramifications for any asset or commodity-based assets, whether that's gold miners, whether that's energy stocks, mining stocks. resource stocks. These are all the types of stocks that would likely underperform in this environment where commodities as an asset class is underperforming equities, which we have seen strong outperformance here for quite some time. Now, one area of the market that has seen quite a bit of strength here is the bond market. So the bond market, HYG, which is the riskier end of the curve with regards to bonds, is showing quite a bit of strength here over the past few days, a little bit of outperformance relative to the S&P 500. Looks like we might be getting that breakout here above that $77 triple top. That would be a pretty significant bullish signal from the bond markets. That would certainly correlate with lower yields. That is a positive tailwind for equities, for bond yields to drop. And that is something that I think equity investors are looking for. We haven't seen the participation in terms of equities as a result yet, but the bond market is one tick of a risk-on environment that we are currently seeing in the markets right now. VIX yesterday settled around that 13% mark. Last week was pretty a roller coaster ride in terms of volatility. We started the week just below 12%. Intra-week, we got as high as 15, and by the end of the week, we were below 13. Right now, we're just above 13%. So overall, if you look at volatility, relative to the past year, it's still very much on the lower end of expected volatility over the next 30 days. So market participants are not necessarily expecting a lot of chop, not expecting a lot of volatility going forward, and that is a potential opportunity for options buyers. So as you're looking for opportunities in this market, whether it's bullish or bearish, looking at buying those calls and puts right now are relatively inexpensive, giving you that ability to leverage your capital and get that convexity from options while risking a relatively small percentage of the stock or ETF's value right now. So in this lower interest rate environment, that is one advantage to trading options. We do have the 10-year yield declining below 4.4% here. This kind of aligns with the TLT chart, the bond chart that I'll show you next, which is the fact that, as you can see, this downtrend line on bonds started to break out higher here. This would be bullish here for bonds, which would be correlate to lower bond yield, which is a tailwind for equities. So we're getting that risk on signal from the bond markets for equities. Dollar index still trading below this 105 level. Our expectation is the yields decline is for the dollar to also decline here as well. The downside target here is around 102.5 in terms of this trading range that it was in prior to the breakout here. This breakout did not get any follow through. We kind of traded back into this range, tested the top of the range, got rejected. So the next downside target here is this 102.5 level here to the downside, especially as interest rate yields decline. Gold, we did see gold catch a little bit of a bid here yesterday, despite the fact that gold kind of formed this 2450 double top here. My hunch is, given the softness we've seen out of commodities overall, there's a higher likelihood that gold will start to fail at these levels and start trading lower. The major support level here is 2300. We'll see how it reacts to 2300. If it breaks below that, then the next level here is 2150 here to the downside. So gold suffering a little bit here alongside with commodities, even though it's one of the stronger commodities. But this is really one of those places in the market where I see some significant downside risks. As well as oil. You see oil break down below this key $77, $76 support level. We're trading as low as $74. So supply seems to be there seems to be plenty of supply at the moment for oil, and this is really what's causing oil to drop here below some major support levels. So this is going to be affecting energy stocks, mining stocks. So this is something to consider at the moment, the fact that oil is incredibly soft. And then looking at the major sectors, And this is really one, technology, given the fact that it has a 30% weight on the S&P 500, is one that we really have to pay attention to, because technology largely over the past few months have been underperforming the relative to the S&P 500. In the last month or so, it has really come back to life with regards to its relative strength, and we were viewing that as a general positive as equity markets recently printed new all-time highs. However, one of the biggest concerns that we have is the fact that it was the only sector leading the markets higher, with the exception of utilities and healthcare. Defensive sectors leading the markets to all-time highs is never a good sign. So when you do see growth sectors like technology start to lead as we get back into all-time highs, that's a good sign. But over the past few weeks, what we have seen is that this technology strength lead the markets higher, but it's really the only sector leading the market. It's the only growth sector leading the markets higher. And what's concerning to me the most was that on Friday, which should have been a really strong day for technology, that's actually one of the weaker days for technology. Technology did not rally back the same way the other sectors, some of the other sectors did. So for those reasons, the outperformance for technology very much was lost on Friday and continued into yesterday. But it doesn't mean it's going to continue, that underperformance will continue, but the fact that we didn't get follow through from technology yesterday, on Friday and today, yesterday and Friday, is somewhat concerning with regards to the health of this market rally. We did see consumer discretionary find a little bit of a bid, but overall, the long-term picture here for just consumer discretionary is incredibly poor. And that's really concerning here for the equity markets, because you need to see consumer discretionary, technology, materials, industrials. These are the sectors that should be leading the markets higher as they print new all-time highs. Yet these are none of the sectors that are participating in these rallies. These are some of the sectors that have some of the worst performance relative to the S&P 500. And that's a big concern that I have. One sector that is performing is communications. Communications is kind of is a bit of a neutral sector with regards to whether it falls into growth or value. You have some growth names, you have some value names that kind of balances each other out. You have some of these old names like AT&T, Verizon, Comcast type stocks in this sector, and then you have other names like Netflix, really growth names that are in the communication sector, and they kind of balance each other out. But communications is recently starting to show a little bit of strength here. It did make a new all-time high. However, it didn't make a new all-time relative high, so that hasn't been confirmed. And you have this huge negative divergence here. So every time it makes a higher high, it fails to make a higher high in terms of momentum. So this is one that my hunch is that this is likely going to fail and reverse back into the trading range rather than be an opportunity here to the upside. So where we are seeing performance, not necessarily showing us the best performance. Financials still underperforming here over the past month and a half here. So not expecting a whole lot there. Consumer staples, a small amount of underperformance here over the past month or so. Healthcare showing a little bit of outperformance one week, but if you can see the long-term underperformance, that's a concern. You have materials that has continued to decline in terms of both on an absolute basis and on a relative basis. You generally want to see materials and industrials participate, but that's exactly the opposite of what we're getting. Look at that underperformance here for industrials over the past month or so. So these are the leading sectors that should be leading the markets higher. Real estate moving lower, both on the absolute and relative basis. So when you look at these types of charts, it doesn't instill confidence in this market rally. You're not seeing technology, discretionary materials, industrials, real estate leading the markets higher. It's utilities, it's healthcare, it's technology losing some of that steam here. Utilities, the strongest sector at the moment. You really can't have utilities leading the equity markets to new all-time highs and be confident that we're going to continue to print new all-time highs unless some of the other sectors start coming back to life. And we have just yet to see any signs of that. So for those reasons, I still for this week caution. I'm advocating caution here as equity markets look like it's printing, near all-time highs and potentially making new highs. I exercise a lot of caution in this type of market environment when we look at the market internals that we're currently seeing from these names. Okay, so leaving you with some ideas here for the week, let's take a look at some of the names that we are paying attention to here right now. First one I want to point you to is Home Depot. So looking at Home Depot, this is really the consumer discretionary stock that's losing a lot of relative ground. So if you look at Home Depot, as you can see, it's trading, just above that 325, 330 support level here. And the question is whether this bounces higher here or breaks below that. And if you look at that relative performance chart here below, that's quite poor in my opinion. That's more likely to break below that than bounce higher and continue higher. Home Depot trades at 21 times forward earnings, but margins are pretty thin and growth rates are quite anemic. You're expecting low single-digit growth rates for both EPS and revenue. So trading at a multiple that is slightly higher than the rest of the market when margins aren't particularly thin or aren't particularly strong. I think Home Depot, just from a valuations perspective, also has some potential downside risks. American Tower, this is a real estate REIT, obviously for cell phone towers. Showing a little bit of outperformance here. As you can see, it made a new recent high here above that 195 double top. This really starts to target maybe the 207.5 level here to the upside, and maybe the 217.5 level extended targets here to the upside. You see that the relative performance here is strong as it kind of made this move higher here. So it's outperforming the S&P 500. Momentum recently just turned positive. It has all of the signs of a potential bullish to bearish or bearish to bullish reversal. You can also, potentially draw some an inverted head and shoulders pattern here, long-term bottoming formation, however you like to think about this chart. But overall, no matter how you draw your chart, this is starting to show some positive signs here. Momentum is turning positive. It's broken above horizontal and trend lines, resistance levels. American Tower, worth paying attention to for some upside potential. Another stock that I think has some downside potential, unfortunately, is Amazon. As you can see, Amazon, whoops, what happened here? Don't know what just happened to my screen. Bear with me 1 second. Okay, I think I got my screen back. Amazon, as you can see, still holding 175 here right now in terms of support. But if you look at the relative performance, quite poor here. Actually broke some of that support level here already. So, Amazon trades at a pretty rich valuation, 37 times forward earnings, despite the fact that Amazon is expected to grow fairly quickly. However, there are some concerns with regards to oh, actually, sorry. Can you guys see my screen? All right, my computer seems to be acting up right now. Apologize. Hopefully you'll be able to see my screen now. So what I was showing you here before is Amazon so far holding this 175 support, but if you look at the relative performance here, it's starting to look uh, quite poor, and it looks like it's starting to break below some of those support levels here as well. So this is giving me the idea that this could potentially break below 175 and continue to potentially fill this gap at 160. Amazon trades at a pretty rich valuation, 37 times forward earnings, while net margins are only 6%. They are expected to grow fairly quickly, but as consumer spending has started to decline, I think these valuations that it trades at, which is extremely premium, we're talking about nearly double the S&P 500 valuations, I think have some downside risks. It's already come down from about 45 times forward earnings down to 37. So this is one that I think is worth paying attention to. Um, Unfortunately, my computer seems to be acting up, so I'm going to end that here for today. Hopefully, this gives you a good sense for how I'm viewing the markets with regards to the overall equity markets, and again, exercise a little bit of caution in this type of market environment. With that, thank you so much. I hope you guys have a great trading day.